Barton, first to you on some of these results, because you have a hold on Amazon and Apple and aren't quite as enthusiastic as some of the other sell-side analysts on the street today. What's wrong with the Amazon report, which is being universally embraced, up 12%, and seems like a real standout?
Well, certainly I think there's relief in Amazon. I think there was a lot of concern going into the report. But, if you look closely at what was happening, there's some things that you could look at as maybe not what you would ideally want to see in a stock that's up 12% today. One of those is
like
that
what?
the core kind of value driver, web services, slowed, growth slowed, margins declined. The other is that their legacy, retail, while growing, is not really the growth story that it was. I would back into about a 12% growth rate in North America for everything combined in retail. And inflation is 9%, units up globally 1%. So it's really inflation. It's not really an outperformance secular story. And margins, they're spending. They were supposed to get some margin inflection as they grew out of the overspending into the pandemic, but they're sucking up a lot of that in the next quarter with spending on staffing and computers for AWS and also content like Thursday Night Football, which I think is a real head scratcher. Fox couldn't make money on it. These guys are paying twice as much money without even the affiliate revenue stream underneath it. So I'm not sure how the ROI works on that. So, I think there's some concerns on Amazon.
Well, so we should know your price target 118 and your neutral rating. I'll take the AWS part, Barton, because while it was a slower rate of growth than last quarter, it was better than expected, and it's still 33%, which is even higher than some of its cloud competitors, which a lot of folks think that suggests that they're still taking share.
Yeah, I don't think it's higher than Microsoft, which constant currency was up, I think, 46%. Google reports their comparable cloud business is buried within their disclosure. And I think if you back into it, it was faster and maybe 40%, so a little bit faster than Amazon. So I don't think they're a share gainer. I think they are a share leader. But, this is a sector that has a great secular tailwind. And I think a lot of people really want to ascribe huge multiples to it. But the peer set, the multiples have come down. I think it is getting very big. There's a law of large numbers kind of issue here. Good story, but I think that's pretty well known at this point in the stock.
So, Tim, as the fund manager, longtime, I think, shareholder of both Amazon and Apple, do you want to take the other side?
Well, it's not really taking the other side. I mean, as a long-term holder of these companies, they're very important to the overall market, right? They're two of the largest companies in the world. They're owned by investors in almost every style and index fund that's out there. So seeing movement in these stocks is pretty constructive. And perhaps the street had been too bearish going into earnings across the board, right? We've had 60% of companies are beating earnings, certainly lower than the 77%. That's the 3-year average of earnings beats. But it's just constructive for equities as a whole. And we don't spend a whole lot of time getting worried about quarter-to-quarter revenue and earnings changes. You've got two great companies that have created significant moats for themselves.